This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Everything you thought you knew about the character of the market started to reverse around Halloween, with laggards becoming winners and winners becoming also-rans. Up next, time will tell if these are sustainable shifts. And be careful going too far in the other direction. But patience, diversification, and attention to valuation are paying off really for the first time in years. Let's discuss. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. You may have heard the concept of Bizarro World before. Bizarro World is a fictional cube-shaped planet in the DC Comics universe. It's also the working title, by the way, of a classic Seinfeld episode where essentially everything is the opposite of normal. Well, such has been the case starting around Halloween and enduring really through this week at the asset class, market sector, and individual stock level. Winners have turned to underperformers and vice versa. A little later in this podcast, we're going to talk about this and frame what has become even a more confusing environment where we're all drinking through a daily fire hose of political, geopolitical, and economic headlines. It's only the third week in January. I am already exhausted. All right, so let's get to it. By the way, just a quick side note, we are at the one-year anniversary of the first year of Trump's second term. Just to give you some frame of reference, the S&P up roughly 16% in his first year. You compare that to other first terms, it's below first years, I should say. It's below the first year of his first term. The S&P did 24%. Biden's first year, 19%. Obama's first year, by the way, almost 35%. Why am I bringing this up? Just to make the point that I've made 1,000 times and I will continue to make again. The markets are a lot less influenced by who the president is than you think, because regardless of whether the president is considered to be pro-business, less pro-business, I'm not going to say anti-business, but less pro-business, regardless of all the agenda that obviously you compare Obama and a Biden to Trump, they're almost antithetical. The markets have a lot of other influences well beyond politics. And by the way, even within the S&P 500, if you look at what did well and what didn't do as well in Trump's first year of the second term, communication services were up 32%, technology up 23%. Meanwhile, the sectors that were perceived maybe before he started to be the most likely biggest beneficiaries, I should say, of Trump policies, energy, consumer discretionary, and financials, those were the three lagging sectors. So, again, I'll say it one more time. Be very careful conflating your politics, or maybe less so your politics, your kind of forecast or expectation of what politics and policy will bring to the market with the way that you actually position your portfolio. You often get outcomes that are completely different because there's so many other factors, earnings, inflation, interest rates, that are the real driving forces most of the time behind stock prices. Also, just another reminder, I know we've had some volatility over the course of the last couple weeks, certainly headline volatility. The markets haven't been as volatile, but they've been a little bit more volatile than they were late last year. Don't forget, since 1980, according to JP Morgan, the S&P has averaged a 14.2% annual drawdown. And 5% drawdowns happen pretty much all the time. 92% of years since 1951, also according to JP Morgan, have we seen at least a 5% correction. And as I mentioned last time I did the podcast, midterm election years are actually the worst. So if you go back to 1946, you've averaged an intra-year drawdown of about 18% for the S&P 500. I mean, just look at this bull market, right? Despite the bull market, we've had essentially three bear market drawdowns along the way, right? COVID, 2022, and then last April, Liberation Day. It always looks easier when you're looking back on it. Like, oh, look, this is what the market's gone up over the last 10 years. We often forget about the periods where it took a lot of discipline, a lot of keeping our emotions in check to get through it. I expect that this year is not going to be any different. Okay, so just be prepared for that. Another kind of quick sidebar here before I get into sort of the subject at hand, some of the rotation that we've seen in the market. Now, I read a really good piece from the financial writer Nick Maggiulli, who I've quoted a number of times on this podcast, entitled, "Why You Can't Time the Market Even When You Know the Future." So I always talk, I know Chase does as well, we always talk about the pitfalls of market timing, how you have to be right twice, not just on the sell, but also the reentry. But Maggiulli makes the further point that even if you knew the economic data, the headlines ahead of time, even if you had a crystal ball, still doesn't mean you'd be right on market direction, which is really interesting. And he uses the analogy, the factual analogy of COVID and all the headlines that we had starting in March of 2020, really all the way through March of 22, that 2-year period. And I'm not going to run through all of them, but he details all these headlines about not only deaths and the proliferation of the disease, but also what science was doing in retrospect, when drug companies were coming out with certain news and how studies were progressing. So I'm not going to detail all of those, but I think the point that he's making is he asked the question, had you known all this ahead of time, when do you think the optimum time would have been to have put money back into the market? Remember, we had that big 20+% drawdown in the spring of 2020. When would have been the best time to kind of get back in? And he makes the point that he would have picked November 15th, 2020, because that was the day before the 95% effectiveness of the initial Moderna trial was announced. That was overwhelmingly positive information that really turned the tide in terms of potentially not only treating COVID cases, but preventing the spread of COVID. Well, guess what? Had you invested on November 15th of 2020, you would have missed out on a 23% gain from late February through November by investing so late. You would have missed out on 23%. What was the actual best date to invest would have been March 17th, many months earlier. Right? That was when Moderna first started trials for their vaccine. We had no idea whether those trials were going to lead to an effective vaccine. No one did at that time. And the death toll in the U.S. was, at that time, less than 2% of where it ultimately would end up. But that was the best time to invest. So what's the takeaway? I'm not going to belabor the point on that COVID analogy or COVID example. The point is that the market is an extraordinarily complex discounting machine that brings all information and expectations about that information into prices in real time, almost instantly, right? And so when you get a headline, and I say this, it's so relevant today, right? Greenland headlines, tariff headlines, all the things that Trump is coming out with, right? The headline is just a first-order effect. It's just the initial information. The headline misses how investors are going to respond to that. Also misses how investors will respond to the response, and so on and so forth, right? In other words, even if you know the future, you don't know how others are going to react to it, and you don't know what was already discounted, what investors were expecting. I mean, how many times have you seen a earnings report be fantastic, and the stock actually goes down, right? Because everyone expected it to be fantastic. The stock price had already moved in advance of that. Buy the rumor, sell the news, right? So I just say all this, that if you are sitting there this weekend, snowed in, reading the paper, watching cable TV, and thinking that based on your expectation of certain headlines or the headlines you're actually reading in real time, that you're going to be able to game that and think that you know how the market's going to turn out, I would be very careful with that. Just look at last year. We all know that the S&P had a double-digit gain, right? The Dow had a double-digit gain. But was that a logical forecast for last year when the war in Ukraine was dragging on with no resolution? Stunning escalation, U.S. and Israel carry out joint airstrikes on Iran. The Federal Reserve would feel confident enough to begin an easing cycle and cut rates 4 times. ISM manufacturing index would contract every month from March through December. I could go on and on and on. But based on all the news flow, there was no way that anyone would have forecasted that type of gain. All right, I'll leave it at that. I think you get what I'm saying. But it's very important to keep this in mind, given, again, as I mentioned at the top, the literal fire hose of information that we are getting every day that has the potential to affect our decision-making if we let it. Okay. Let's flash forward to this year, right? Well, I mean, here we are, only the 3rd week in January. We've already dealt with the military operation in Venezuela. Trump has said he wants to ban institutional investors from buying single-family homes, barred defense companies from issuing dividends and doing stock buybacks, then called for a 50% increase in the defense budget, directed Fannie Mae and Freddie Mac to purchase mortgage bonds, mixed November jobs report, announced credit card interest rates must be capped at 10%, Department of Justice opened a criminal investigation into the Federal Reserve chair. I could go on and on and on. That's only 3 weeks in. But here's the key thing, and I've talked about this a lot. Those 10 things I just mentioned, all important, okay? All important to a lot of people in this country. However, not all of them affect what really drives stock prices, the outlook for corporate earnings. In fact, some don't affect them at all. So that's going to be the key point that I'm going to continue to harp on, not only on this podcast today, but really in perpetuity. You've got to really filter out the things that the market cares about, and the market cares about the things that drive corporate fundamentals. There are a few exceptions to that, right? You know, the 9/11s and, you know, some of these huge geopolitical and exogenous threats, if you want to put it that way. But most of the time, the market is weighing, and even in the recent example with Greenland and tariffs, right? The Greenland news didn't actually move the market that much. It was when he announced potential tariffs that the market really moved. And then, of course, subsequent to that, the removal of those tariffs, right? Or at least backtracking on the threat to raise tariffs on Europe. That was market moving, right? Because tariffs can affect earnings. Let's keep that in mind. And what do we know about this year? Well, despite all the headlines, FactSet consensus estimates are still showing expectations for 14 to 15% earnings growth this year. Now, take that with a grain of salt. A lot can happen to change those estimates, but for now, that's what the market is looking at. So it's kind of hard to have a negative outlook as your base case if earnings come in somewhere in the low to mid-teens. Okay, keep that in mind. I'm not going to get too much into the headlines. The Greenland/European tariff outlook, I'm hesitant to even talk about because it's so headline-driven. You know, it could age like a dirty diaper by the time you listen to this podcast, right? But certainly some of the more draconian things that the headlines were contemplating are kind of hard to pull off. I mean, so for example, could the U.S. threaten a NATO withdrawal? Well, that would require congressional approval and 2/3 Senate majority. That would be very hard to get in the current environment. Could Trump threaten the removal of troops from Europe? Well, the Secretary of Defense and the head of European Command would have to certify to Congress that that was in the best interest of the United States. Even the tariffs themselves, right? The Supreme Court, as we know, is contemplating whether those are legitimate. So I think some of the worst case scenarios, including an outright invasion of Greenland, those were not likely to be the case. I think the market is just going to be concerned about an all-out trade war with Europe, which those odds have gone down this week, but certainly aren't off the table. The other thing, of course, that's been pretty newsworthy has been that Trump threat to cap interest rates on credit cards at 10% at least for a year. Keep in mind, that is not something that can be done through executive order. It has to be done through approval of Congress. Now, we all know that Trump could lean on Congress significantly to make that happen. But so far, there's already proposed legislation on the table from Bernie Sanders and Josh Hawley. It's actually a bipartisan proposal. But what's interesting about it is there are virtually no co-sponsors. And the number of co-sponsors is typically a measure of internal support. It seems to have a pretty low odds of passage for the main reason that it tends to work against the people that it is ostensibly trying to help. If credit card issuers were faced with the prospect of a 10% earnings cap or interest rate cap, guess what they'd do? They would cancel credit for a wide swath of their subprime borrowers. So you would have, I think, a fairly significant percentage of, let's say, the bottom third to a half of the economic strata in this country cut off from credit. That's the last thing. And in fact, Jamie Dimon at JP Morgan came out just this week and said it would be, quote, an economic disaster, end quote, if that cap were to go through. So again, the headlines are one thing. The markets have taken a more sanguine approach to it. We will see what happens. You can't underestimate the power that Trump has when you have a Republican Senate and Congress, but I would not make that a base case. All right, I don't want to get too much into the macro picture today. I did want to say on a positive note, and I've mentioned this multiple times over the past few months, that I think the market is underestimating this tsunami of stimulus that is coming our way over the course of the next 4, 5, 6 months. Now, a tsunami of stimulus can work two ways, right? It can certainly help corporate earnings, consumer spending, but it could also potentially be inflationary. So it could be potentially a double-edged sword. But on balance, it's a big reason why a lot of analysts do have 13, 14, 15% earnings growth projections for this year. Right, and the stimulus is coming kind of from four different things. The federal balance sheet, right? Quantitative tightening ended last year. The federal balance sheet is actually expanding. Tariffs are coming, yes, but by the middle of the year, the comps actually go negative, meaning that tariffs will actually be lower the middle of this year versus this time last year. Okay, because of some trade deals and what have you. And I know there's still some volatility with trade and tariffs, but that's kind of the base case. Fiscal policy, we know that tax cuts are coming for consumers and businesses, which will really show up during refund season. And then financial deregulation. And, our friends at Strategas, they estimate it's almost $1 trillion more stimulus, or I guess the delta is almost $1 trillion in terms of stimulus versus restrictive policy this time last year. Okay, almost $1 trillion. So that's a big deal. Now, again, the flip side of that is the market's already walking back the number of Fed cuts for this year. Just a few weeks ago, the market was pricing in 3 cuts this year. Now they're pricing in 2. All right. So that's going to be very interesting interplay to watch. Probably better economic data, certainly better than the fourth quarter, combined with a potentially more hawkish Fed. Okay, I say potentially because I know that the Fed chair could be replaced here in the next few months. We'll see. And then the other thing is with inflation itself, right? Inflation has been coming down to a degree, mainly because of housing and rental prices and gasoline prices to a lesser extent. But people like Amazon and Walmart are talking about tariffs flowing through a little bit more into prices. Plus, if you get this economic stimulus, is that inflationary? So we will see. There are very, very much bull and bear cases for the economy over the course of the next 6 months. But I think overall, it should be a supportive environment for corporate earnings, even if interest rates aren't as much of a tailwind as I think maybe some people had hoped for, a couple months ago. AI stocks still dominate the market, but valuations are almost back to dot-com bubble levels. How should you balance participation with diversification? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WIG Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
All right, enough on that. I want to really get back to the market itself. I talked about at the top how we're in Bizarro World, how kind of everything we knew about the leaders and the losers or the leaders and the laggards has shifted and really started shifting around Halloween, late October. But in the midst of, and I'll talk more about this kind of rotation that we're seeing in a minute, but in the midst of that, I would say a couple things. For one, it hasn't been the case for a while that the only game in town has been tech. I know that's still kind of a popular narrative in the media that it's only tech, it's only Mag 7 that has done well. Really not the case. In fact, if you look at it last year, no sector in the S&P 500 was negative for 2025. Yes, some were better than others, but no sectors were negative. That's pretty rare. That shows you broad-based strength. Now, I will say that only 153 stocks, according to FactSet, in the S&P actually beat the S&P, okay? So that's a little bit narrower than maybe we would like, but still, it's not the case that only a few stocks beat the S&P, right? A good chunk of the S&P actually outperformed the S&P. The other thing I would say, though, and again, I'll get to the rotation in a second, just because large cap tech AI narrative has lost some of its luster doesn't mean, in my opinion, that we're in an AI bubble. I know that's gotten a lot of play, and it's almost become an assumption, to be honest with you. It's become almost consensus that AI is a bubble. But I'm not so sure about that. I made the point a couple weeks ago, and I'll make it again. For one, only 2 out of the quote-unquote Magnificent 7 names actually beat the S&P last year. Only 2. NVIDIA and Google. All the others underperformed. That's probably not what you would think if you thought that we were in a bubble, right? That means if 5 of those 7 underperformed the S&P, the other 493 names must be catching up, both in terms of price appreciation and maybe eventually earnings growth as well. The other thing is, and I think this would surprise a lot of people, valuations have actually been flat in the market, overall market, for about 5 years. Probably wouldn't have guessed that, right? Yes, earnings growth has gone up and stock prices have gone up, but valuations, the multiples that people are paying for those earnings, they haven't gone anywhere in 5 years. That's completely unlike the dot-com era, where PE multiples expanded so dramatically, particularly going into that last year, spring of 2020. Forward price-to-earnings ratios for companies like Meta, Google, Amazon, Microsoft, if you look at it on FactSet, they actually declined over the last 12 months. Think about that for a second. I don't think too many people would have guessed that. So what are the takeaways from that? Well, as you know, I've said this multiple times. History shows there is virtually no correlation between the market's price-to-earnings ratio and how the market performs over the next year. So even though what I said is just true, that valuations haven't expanded much, they are elevated. I mean, they're certainly elevated versus history. But that does not necessarily mean that the market has to go up or down over the course of the next year. It's not a positive or negative correlation. There's no correlation. Okay? In fact, the other thing I would say about that is a lot of people have said, and I would say this as well, that the fundamentals justify these multiples. Okay? Operational efficiency has improved. Balance sheets are healthier. Technology's reduced friction across production, distribution, management. Business environment today is structurally different from prior decades, and I think markets are pricing that reality. In fact, Sam Rowe, the financial blogger who I often quote on the show, he made the argument just last week that he actually, it's probably better for TV than radio, but he had a scatter plot that shows the forward price to earnings multiple against forward net margins for the S&P. And he broke it down into 4-year intervals going back 20 years. Long story short, the relationship is remarkably consistent. As profit margins expand, multiples drift higher. So the fact that multiples are higher today than they were 10 years ago, 15 years ago, you can superimpose that onto a chart of the fact that we have the highest profit margins in history. Pretty logical argument there, okay? And I would also say, again, going back to the idea that valuations don't send a signal about the markets. U.S. equities have been in the top 1 or 2 deciles of valuation, according to FactSet, 96% of the time since 2013. Yet the market's been higher, significantly higher over the last 12, 13 years, right? Last thing I'll say is there was a piece from Goldman Sachs, I guess about a week ago, and they essentially made the point that valuation metrics are not historically mean reverting. They were kind of challenging the narrative that, well, if the market's expensive for a while, automatically it has to get cheap to kind of counterbalance, right? And that there's some sort of magical trend line of maybe 15 or 16 times earnings that the market has to revert to. Goldman basically made the point, listen, we've analyzed this every way possible. We see really no factual, scientific, statistical basis for that idea. Valuations do not have to mean revert. In other words, they can be elevated and stay elevated. They don't need to revert to where they were decades ago, and mainly for just the reasons I just mentioned, right? Things are structurally different in many ways. I think what it does mean is there's less margin for error. Right? And we've seen that with some of the big cap tech stocks when they reported earnings over the past couple of months, right? You saw that from Broadcom and others where the earnings were still good. Revenue growth was fantastic, earnings growth was fantastic, but they did not exceed expectations. There was kind of nowhere for the stock to go after a 60, 70% run, and the stock, has corrected off of that price level. That's the reality, is that the bar is high, not that stock prices can't go higher. Essentially, higher valuations already reflect a lot of good news. That's the way I would put it. By the way, speaking of the fact that I'm not convinced we're in a bubble, bubbles are also typically driven by excess leverage, financial leverage. We certainly saw that in the banking system, right? During the financial crisis, we certainly saw it in the tech and communications universe at the height of the dot-com bubble. Well, debt, again, according to FactSet, was essentially flat for 5 years. Only a 9% increase in issuance in 2025. You compare that to triple-digit debt growth in the 1990s, 111, 152, and 187% year-over-year growth in debt issuance the last 3 years of the decade of the 90s. Totally different leverage environment than what we saw back then. So listen, as I mentioned, I'm not trying to make the argument that tech is cheap, that there isn't some speculative fervor in that space, just that nothing today really reminds me of the dot-com bubble in a lot of ways. And we've already seen pretty significant pullback, or at least a moderation in activity in a lot of the big cap tech stocks. And as I mentioned, it started around Halloween. Since that time, if you look at the largest 8 stocks in the S&P, they've underperformed every other decile in the S&P 500 since that time. And if you look at it from sort of an individual stock level, as of, I guess it was probably Wednesday when I did this, Amazon's 11% off the high, Apple 15% off the high, Tesla down 16% off the high, NVIDIA down 17% off the high, Microsoft down 18% off the high. What we've seen is a moderation in price, a correction in price. We have not seen a blow-off, hyperbolic rise in these stocks followed by a spectacular crash. So what I would say, what I'm kind of trying to say in a long-winded way, is a moderation in those stocks, a pause in the performance of those stocks, I would consider to be healthy, right? And we've seen, if you've been a shareholder of Apple or Amazon or any of these names for 5, 10, 15, 20 years, you've seen numerous double-digit drawdowns along the way. You've still been rewarded at the end of the day. I don't know if this is all that different. That's kind of what I'm saying. But let me talk about this rotation, because regardless of how you feel about large cap tech, we have seen a pretty significant pickup in performance in virtually everything else besides large cap tech. Charlie Bolello, the financial blogger I follow, he called it the reversal of everything. The reversal of everything. The biggest secular trend of the last decade was the complete and total dominance of U.S. large cap tech stocks. Well, we started to reverse a little bit, like I said last year, mainly with the rise of international stocks. International stocks outperformed the S&P by their biggest margin since 1993. According to FactSet, the last time emerging markets and developed markets, international developed markets, outperformed the S&P was 2017. So it's been 8 years of 7.5 years of underperformance by those markets, going back to 17. Prior to that, last time they outperformed was 2009 and then 2007. So there have only been 3 years in the last, 18, 19, where international has done better than the S&P 500, but last year was one of them. And kind of everything went right for foreign stocks last year, right? Not only did you have pretty good earnings growth, particularly from Europe, but you had extreme disconnect in valuations. International was about as cheap relative to the S&P as it had been in a decade. And of course, you also had a falling dollar. So it was kind of like the trifecta of tailwinds for international stocks. We don't know if that will be recreated this year, but that was one significant performance shift. And then more recently, just in the last few months, you've seen the rise of the average stock in the S&P. And we've talked about this before. The equal weighted S&P versus the market cap weighted S&P. For several years, the market cap blew it away because of the rise of those, large tech stocks that dominate the market. More recently, last few months, it shifted to the average stock doing better. And, I've made the point before that, often I look at a sector's earnings contribution to the S&P versus the weighting from a market cap perspective of that sector in the S&P. So, for example, financials are contributing, this is according to Strategas, financials are contributing about 20% of S&P earnings, but they're only a little over 13% of the weight in the S&P. Healthcare, contributing a little over 11% of the earnings, only about 9.5% of the weight in the S&P. So they're outpunching their earnings, their fundamentals are outpunching their weight, okay? Tech is underpunching, okay? Tech is contributing 8.6% of the earnings, but has 14% of the market cap. So there, I would argue there is a fundamental underpinning, maybe justification for some of this rotation. You're also seeing it in terms of earnings estimates. The other 493 names besides the Mag 7, for example, second half of this year are expected to have better earnings year over year. Now it shifts back in 27, but if you look at FactSet consensus, that's kind of where we are. There's also some room for margins to pick up. The overall S&P, record high profit margins, but if you just back out the 493, but beyond the Mag 7, not quite at high profit margins. So if mainstream corporate world is able to kind of really harness, the productivity gains, AI, what have you, maybe there's some room for expansion there. And then specifically value versus growth. Some of those sectors like financials, for example, healthcare, those are the strong denizens of the value indexes. Value has started to outperform versus growth. And historically, these are good conditions for that. Goldman Sachs noted that when real GDP growth accelerates above 3%, like it's expected to in the first half of this year, that typically favors value stocks because there's less need to kind of find the handful of companies that are still growing in a sluggish environment. When growth is more widespread. That's better for value stocks. Value also tends to do well when there is dispersion in sectors, where there are more winners and more losers. It's not just an entire sector moving in unison. So they make the case that value could do better. The last thing I'll say is small cap stocks. Small stocks, as of Thursday, when I saw this data point, according to Larry Adams here at Raymond James, had been positive 13 days in a row. 13 days in a row. That's the longest streak since 2008. Similarly to what I said about international stocks this time last year, valuations are cheaper and expectations are lower than they are for large stocks. Flows into exchange-traded funds are much lower for small stocks versus large stocks. So you have low expectations, low investor flows, but the Russell 2000, the main small cap index, just broke out against the NASDAQ 100, which is basically a big cap tech index, to its highest level in about 10 months. Okay, so the seeds are there for small cap stocks to do well. But I'll caution you, we saw something similar right after Trump was elected a year ago, right? Small cap stocks did very well, only to yield to underperformance going forward. Let me be clear. It's not that small stocks have done badly over the last couple of years. It's just that they've lagged large caps. And like international, small caps have really lagged for most of the past 10 to 15 years. But I wanted to close here with just kind of a few reminders, if you will, from this rotation. One is that diversification is hard. It's hard. When you have, let's say, your company 401k and you have a small stock fund, an international fund, a large stock fund, and you look at the last several years and you're like, why the heck do I have, or let's go further. Look back at the last decade. Why do I have all this money in the international fund and the small cap fund, or even the bond fund for that matter, when my large cap growth fund has done so well? It requires a lot of patience because these big asset class, look at gold. Gold's going crazy right now. Silver's going crazy. Silver had been a dog for well over a decade. So you have to have patience when you are diversifying. Remember, as I've always said, if you're properly diversified, there's always something in your portfolio performing poorly. You have to have the patience to stick with that. So when you're evaluating your portfolio and you have some things that are down, and I'm not talking about individual stocks, but asset classes that are doing much worse than other asset classes, that's not a sign of portfolio failure. That might be a sign of portfolio strength, of portfolio intelligence. I could say the same thing with bonds right now. I'm sure people are out there saying, why do I own bonds? When, the S&P is coming off a double-digit year. Well, let's say things don't go so well for stocks. Maybe you're going to be happy to have some bonds that are getting 4, 5, 6% in the portfolio. Okay? Just keep that in mind and keep that, and when you're evaluating your portfolio, not everything has to be quote-unquote working for you to have a smart portfolio. Kind of related to that, last year's winners are just as likely to be this year's dogs, and vice versa. I've quoted this before. There was a Morningstar, I think it was 2005 study that found in all 17 fund categories they examined, the returns earned by investors were below the returns of the funds themselves. Why is that? Because people were hopping out of the of the worst performing funds, I should say, and hopping into the best performing funds when looking back on portfolio performance, retrospectively, right? Which in many cases is the worst thing that you can do. One other takeaway, two other takeaways. One is that markets can change leaders without breaking. One of the narratives last year is when AI stocks or the Mag 7 stocks, don't do as well, we're in big trouble. The S&P has to collapse. Well, we found out that has not been the case, at least up until now. Other stocks, that other 493, have picked up the baton, so to speak. And as I mentioned, only 2 out of the 7 Mag 7 stocks actually beat the S&P last year. Still, we've been able to have some pretty good gains. Last thing I will say is there's a practical element to this as well. right? So yeah, we want to have some balance in the portfolio between value and growth. We want to own different sectors, maybe some other asset classes. But you also have to look at after-tax returns. So let's say you were 60% U.S. large cap growth in a taxable account, a non-IRA account. It's pretty darn hard to suddenly adjust and say, you know what, I'm going to be 30% U.S. large cap growth, and I'm going to add to something else. Why? Because it might cost you, depending on the size of your portfolio, thousands, tens of thousands, hundreds of thousands of dollars in capital gains to make that switch. Okay? And that's something we wrestle with as well. It's not just performance, it's after-tax performance. If you made a 10% return, but also your portfolio is distributing 10, 15, 20% capital gains, your overall return may not look that hot. So managing portfolio balance, asset allocation, diversification in the context of taxes, your financial plan, overall goals is very, very important. That's something that we I don't want to say we wrestle with, because we've been doing it for a long time, but it is a challenge that we take very seriously here on a day-to-day basis. All right, I'm going to leave it at that. I've already gone my 40 minutes here. I do have a few things to say on some individual stocks. We've heard from the banks so far, but we're really getting into the meat of fourth quarter earnings reporting season starting next week. So I'd say over the next couple of weeks, Chase and I will have a lot more to say to you about individual companies and what we're hearing from individual companies, so stay tuned for that. In the meantime, if you're here in the D.C. metropolitan area, stay safe in the snow, and as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.